New York, May 29, Reuters, U.S. stock markets tumbled on Tuesday, on downbeat trading guidance from J.P. Morgan and worries over Italy putting the S&P 500 and Dow Jones Industrial Average on track for their biggest one-day drops in 7 weeks. A political crisis in Rome, and the threat to the euro project it represents, triggered a rush to traditional safe havens like U.S. 10-year bond yields and in turn spurring losses for U.S. debt, pulling down U.S. banks. J.P. Morgan corporate and investment bank chief Daniel Pinto drove another round of selling by saying his bank's second quarter markets revenue would be flat on the year. Story comments, Brian Battle, Director of Trading, Performance Trust Capital Partners, Chicago. It's all the seesaw of trying to figure out how real the Italian political threats are. This is Italy, so this matters. This isn't Greece or Crete. The Euroscepticism is real, so that has put fear into the market and has put money back into the dollar. The euro is at $1.15. We have a raging rally in long-dated treasuries. The 30-year bond is big and it's deep and it takes a lot to move it. We're almost 2 points in price higher. Peter Cecchini, Managing Director and Chief Market Strategist, Cantor Fitzgerald, New York. I've been skeptical and cautious about equities for a few months here. And the sort of developments in Italy, Spain and LATAM, what they really do is they don't present new facts that are particularly devastating to the markets, but they get people to actually step back and think about risk. Frankly, investors have been very complacent, and these sort of macro risks that people had forgotten that existed, are all of a sudden front of mind for them. With regard to U.S. equities, most of the catalysts are in the rearview mirror. I think it's a little bit easier for investors to say I'd rather be a buyer than seller. Peak earnings are behind us, interest rates are rising slowly, and the only reason why 10-year is down is because of the flight to quality. Italian and Spanish banks, European banks' balance sheets are in a far worse shape than U.S. It may probably make sense for them to be down. Banks are down in sympathy. I'm a bit surprised that U.S. banks I feel are just a bit extended, and this is just an excuse. Michael Antonelli, Managing Director, Institutional Sales Trading, Robert W. Baird, Milwaukee. Investors have bad memories of times past. Anyone working in the market today remembers the last European crisis that happened 7 years ago and has it burned into their memories. The Italian bond market has had a hell of a day. The Italian 2-year yield moved from a little less than 1% all the way to 2.7% in one day. That is a bigger move than during the entire crisis in 2011. Italy is a huge part of the international banking system. These kinds of moves being so large, they tend to panic risk assets, even over here, in the United States. Later this week, if Italy came out today and said it was going to leave the European Union, certainly that would be a market-changing event. Things will smooth out, but there are no clues that that will happen anytime soon. The market tends to price in the worst-case scenario and then walk it back. Market reaction stocks. The Dow was down 497 points, or 2.01%, on track for its biggest daily percentage fall since April 6. Likewise for the S&P 500, which was 1.58% lower. Treasuries, the yield on the U.S. The Nasdaq was down 0.91%. 10-year Treasury note fell to 2.7738%. VIX, the CBO Volatility Index jumped 38% to $18.27. The U.S. dollar index was up 0.64%, compiled by Alden Bentley.